How does Warren Buffett invest, and why is he so successful? Warren Buffett, also known as the Oracle from Omaha, is arguably the greatest investor of all time. Warren Buffett is the CEO and largest shareholder of Berkshire Hathaway, who has amassed an astonishing net wealth of $87 billion, making him the seventh wealthiest person in the world as of January 2021. Therefore, it comes as no surprise why his approach to investing has become so popular. Hey everyone, welcome to our channel, Let's Talk Success. Following are the 8 investing principles that Buffett implements in his approach to identifying and investing in companies. Number 1. Long-term value investing. Warren Buffett's strategy is based on long-term value investing passed down from his mentor, Benjamin Graham. According to Benjamin Graham, long-term value investing involves purchasing stock at prices below their intrinsic value and then holding on to them until their price reflects the real value of a company. Therefore, according to Buffett, the secret to getting better returns is to buy a stock and forget about it, which is referred to in the financial service industry as the buy and hold mentality. In his view, constantly buying and selling stocks will erode a significant percentage of your investment returns in the form of commissions and taxes. Number 2, over-diversification is not a good idea. While most knowledgeable investors understand the importance of diversification, unfortunately, many investment managers push the theory of over-diversification, which tends to increase their bottom line, not yours. Consequently, many investors over-diversify their portfolio because they are afraid that any one stock may sink their entire portfolio. But as Buffett alludes to, over-diversification is for people who do not understand much about investing. In fact, over-diversification will condemn you to invest in mediocrity. A well-diverse portfolio should only hold between 5 and 12 stocks, as this will allow you to maximize your returns while minimizing your risk. Number 3, invest in yourself first. According to Buffett, the best investment you can make is in your own abilities. Anything you can do to develop your own abilities is likely to be more productive, which we totally agree with. Buffett also states that one of the biggest challenges when it comes to investing in the stock market is failing to trust your investment decisions, which often stems from a lack of knowledge or expertise about the risks you are taking. Unfortunately, too many do the opposite of what Buffett advocates, by making themselves dependent on others, such as brokers, stock reports, and tips from friends and family, to name a few. In fact, if you continue to rely on others to tell you what to invest in, you will continue to subject yourself to emotional decision-making, which is not a very effective way to succeed in the stock market. But if you invest in yourself, you will gain the knowledge to overcome the fear. Number 4, buy quality companies. Buffett believes in investing in quality companies, as he would rather pay a fair price for a great company than a low price for a mediocre company. Warren Buffett says if the business does well, the stock eventually follows. This is the reason why Buffett only buys stock of fundamentally strong companies called blue chip companies. These are companies that are driven by strong managers, sell excellent products, and are loved by their customers. Such companies will continue to do business forever. A combination of a blue chip stock bought with a long-term holding strategy should be enough to yield future profits. But the appetite for investing in quality blue chip stocks has diminished, with many investors favoring the perceived value of investing in cheap small cap or penny dreadful stocks. This is based on the idea that if the market does pull back, then at current prices, these stocks have the least to fall. But this belief not only costs you money, It usually hinders your ability to generate profits because you are investing your faith in speculative stocks. In other words, you are speculating that a cheap stock will perform better than a solid blue chip stock. Number 5, invest in companies and industries that you understand. While it makes sense to only invest in companies and industries that you understand, unfortunately, too many people get caught up in the hype and speculation of certain investments, such as investing in cryptocurrencies. But Buffett cautions that you should never invest in assets that you do not fully understand, and we totally agree with him. Before you invest, you need to understand how a company or investment works to make money. According to Buffett, if he cannot understand this in 10 minutes, he moves on to evaluate another investment on this basis. All too often, individuals invest in markets or companies they do not understand, which causes emotional decision-making and poor returns. If you don't possess the knowledge to understand how the market works or the risks of investing, you are better off sticking to the top 20 stocks in the market, as these represent the least amount of risk and will support you to build long-term sustainable wealth. Number 6, buying shares is buying a part of a business. Imagine you are buying an ownership stake in the convenience store around the corner from your house. You would automatically think about the competition, suppliers, prices, and etc. You would also consider both the specific location of the store as well as its competitive position in the market. Similarly, when buying stocks, you need to be able to analyze this information using both technical and fundamental analysis to ensure you are investing in good quality companies that will rise over the medium to long term. Unfortunately, too many people treat the stock market and the buying and selling shares like a casino, whereby they tend to gamble with their money. However, with the right knowledge, you can avoid these costly mistakes and so that you protect your downside. Number 7, manage your risk. According to Buffett, his number 1 rule is to never lose money. His second rule is to never forget rule number 1. His other famous quote is to understand that risk comes from not knowing what you're doing. Many individuals know how to buy a stock, but very few know how to sell and consequently end up losing their capital because they have failed to set a stop loss. For those who aren't familiar with this term, a stop loss is a price point at which you commit to selling security. It's used either to preserve capital when a recently entered trade turns against you or to protect the profits of a winning trade. As Buffett states, when a company no longer fits his criteria, he sells. Therefore, we encourage you to resist the urge to make excuses to stay in investment when the risk of holding it becomes too high. In fact, knowing when to sell your shares is critical to your longevity in the stock market. Number 8. Learn from your mistakes and move on. You might be surprised to learn that even Warren Buffett makes mistakes, but he makes sure that he learns from his mistakes. Buffett recommends keeping a record of the mistakes you made so you know what went wrong to ensure you don't repeat the mistake again. Documenting your mistakes is a way of taking responsibility for them, because all too often we sweep these under the carpet as if they never occurred. But being disciplined and accountable are both great traits of excellent traders. That's it for today. Hope you got some value. If you did, please like, share, and subscribe to our channel. See you on the other side. Take care.